Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we're doing a really important deep dive into volatility. And it involves two areas that seem, well, totally separate on the surface. First up, there's this huge, very visible shock, the biggest drop in gold prices we've seen in, over 10 years, driven by some major geopolitical moves. And second, we're looking closer to home at this sort of quiet, almost hidden anxiety. Investor confidence looks pretty high, but underneath that, there's real worry bubbling up about systemic risk, specifically in that lucrative but kind of murky world of alternative assets, like private credit.
Right, that contrast is really stark. And our mission today, for you listening, is to help understand both kinds of risk. We need to unpack, the mechanics of a sudden shock, like how China can sway global prices, but also that slow burn pressure from, say, the SEC starting to look harder at these private assets.
Okay, let's start with gold then, because that recent drop was, well, frankly, shocking in its speed. Spot gold prices fell, 5.5% to over 6%. In just one day. That's the biggest single-day fall since 2013. I mean, that's a massive swing for something people think of as a safe haven.
It is, yeah. But it's maybe only really shocking if you forget what happened right before it. This huge drop came right after what our sources called an enormous and frankly unsustainably fast rally. Imagine gold shooting up $1,000 in just, 60 days? It's like hitting the accelerator and going 150 miles per hour. You just can't keep that up, Try to turn sharply at that speed.
Yeah.
Well, you crash.
So who slammed on the brakes? Sources are pointing to two main things, and the big one seems to involve global policy. Let's talk China.
Exactly, China.
Yeah.
They're the world's #1 gold buyer. They're
Yeah.
basically the biggest player in that market. So when they make policy moves, it's effectively like placing a massive market order. The key moment was October 16th. The Shanghai Gold Exchange basically told investors to invest rationally, control their positions. They pretty much said the market had gotten irrational.
Wow. So in a country like China, when the government, especially through the main exchange, says something like that, it's not just advice, is it? It's more like a directive.
Oh, absolutely. It's a mandate. When the main buyer, the one with the deepest pockets, says stop buying, the price is nuts, well, the price is going to fall. It's the state stepping in. But the real insight here isn't just about controlling the price, it's also geopolitical.
Right, that's what I wanted to get into. Is this just China trying to stabilize things internally, or is there a bigger game here, maybe some involving the U.S. dollar?
It's definitely strategic, yeah. China's been buying up gold steadily while at the same time selling off U.S. treasuries. It fits into their long-term goal of making the yuan more international. They seem to be trying, quietly, to rely less on the U.S. dollar as the world's go-to currency. Think way back, like the old Bretton Woods system, where currencies were linked to gold. China's moves sort of echo that, leaning more on hard assets, less on U.S. debt. So this warning about gold prices, it does two things. Cools off speculation and pushes their long-term de-dollarization plan forward.
Okay, that puts a whole different spin on the volatility. Makes it feel, well, a bit weightier. Now, what about the second driver? The sort of market physics, technical overheating.
Yeah, the technicals. That super fast rally, it was largely fueled by what analysts call weak hands.
Weak hands.
Yeah, speculative money, retail investors jumping in, short-term ETF flows,
Yeah.
folks maybe chasing the price rather than looking at fundamentals. And the technical signals were flashing red. Analysts use things like the RSI, the Relative Strength Index. Think of it like an enthusiasm meter. When it goes above 70, it basically means investors got way too excited, maybe overly optimistic. Gold was up there, in that overbought zone since early September, and maybe even more telling. The price was trading more than 35% above its 200-day moving average.
Okay, translate that for us. 35% above the 200-day average. What does that really signal?
Think of the 200-day average as the market's long-term cruising speed. Being 35% above it is like suddenly driving way, way faster than usual. The market was stretched like a rubber band pulled too tight. It couldn't stay there.
Right, so if the price gets too far ahead of itself, and then the momentum starts to fade, that's when the big players react. The institutional trend followers, they call them CTAs, commodity trading advisors, they saw that momentum sputter. Their exposure, how much they were invested, dropped sharply, from around 70% down to just 20%. And that shift, it triggered this wave of really fast selling. Put that technical breakdown together with China's warning, bang, steepest drop in a decade.
Okay, so quite a storm there.
Yeah. So what's the takeaway for you, the listener?
Well, despite this crazy volatility, you have to remember the underlying issues haven't gone away. We're still looking at huge U.S. fiscal deficits, ongoing debt concerns, things that traditionally make gold look attractive long term. So some see this correction as maybe shaking out the speculators, the weak hands we talked about. For someone investing for the long haul, worried about government debt, this pullback might actually look like an opportunity to buy.
Interesting perspective. Okay, that covers the external shock pretty well. Now let's pivot. Let's talk about risks brewing closer to home. Because if the gold crash was loud and visible, the anxiety in private assets feels quieter, almost hidden. And here's the weird part, the paradox. Investor confidence, according to this Vista study, is actually pretty high, like 7 out of 10. Satisfaction's even higher, 8 out of 10. And if you use a financial advisor, apparently 90% of you are satisfied. That sounds great, right? But there's this generational split emerging. Older investors, they really want that custom personal advice. Younger folks, Gen Z, they're all about technology, digital tools, and transparency.
And that word transparency, that's the key word here because it leads us straight into the less rosy picture. While everyone feels good about their investments on paper, there's this deep structural worry building up around alternative assets, especially private credit.
Okay, define private credit for us simply.
Sure. Think of it as loans made directly to companies, but outside the normal banking system or the public bond market, like a private arrangement. It promises higher returns, which is why it's popular, but it's often really opaque, hard to see exactly what's going on inside. And the collapse of a company called First Brands, that was a real wake-up call for the industry. It highlighted the big potential flaws. Valuations that aren't clear, like what's the loan really worth today? Hidden leverage, maybe more debt than you realize, and the big one, low liquidity.
Low liquidity. That's the one that always worries me. If you own something, you can't sell quickly when you need the cash.
Exactly, you're stuck. If the market turns or you personally need money, you might not be able to get out easily or at all without taking a huge loss.
That must be why we heard Jamie Dimon from JP Morgan give that warning. Finding cockroaches in the system. That sounds serious.
It is serious. That's language about hidden problems, potentially systemic ones, not just one bad company. And you know what follows cockroaches, right? Regulators. With a microscope. They are now intensely focused on these corners of the market that used to be pretty dark, the US SEC. At a recent SIFMA conference, they specifically announced they're reviewing valuation standards and disclosure requirements for non-listed assets. They want to know how these things are being valued. And we're seeing the Bank of England planning stress tests, too. It signals pretty clearly the era of just trusting these opaque alternative asset managers without much oversight. That's ending.
Okay, but here's the twist. This regulatory clampdown is happening just as the Department of Labor, the DOL, is actually pushing to get more of these private assets into people's 401k retirement plans. They frame it as democratization, right? Giving everyday folks access to potentially higher returns.
Which creates this incredible tension, doesn't it? On one hand, you've got the promise of boosting retirement savings with higher yields, but on the other, you have real pushback. Citizen groups, some lawmakers, they're warning, hold on, let's not rush this without enough investor protection.
Yeah.
I mean, think about it. Putting your essential retirement savings, money you absolutely need down the road, into something where the value isn't clear day to day. And you might not be able to access it easily if, say, you lost your job. It's a real clash between chasing returns and needing basic safety and transparency.
Okay, so we've got this sudden gold shock driven by global forces like China and this slower, creeping regulatory concern over hidden risks in private markets right here. So let's bring it together. What does all this mean for your strategy for the listener trying to navigate this?
Well, insight number one seems pretty clear. The days of just blindly investing in private markets might be over. Chasing those high returns in, say, private equity or private credit just because the fund manager has a big name, probably not wise anymore. Sources emphasize you absolutely have to do your homework now.
Meaning what specifically?
Meaning you need to dig in, ask tough questions. What exactly is the fund investing in? How are they valuing those investments? Is it fair? Is it realistic? What are the real liquidity conditions? Can you actually get your money back when you need it? And how good is the manager at actually managing risk? It's that process, sometimes called picking out the gems from the stones. It's now essential.
So diligence isn't just for the big institutions anymore. It's for everyone.
Absolutely. And interestingly, this worry about private markets leads to insight number two. It actually makes traditional public markets look, well, pretty good again. Why? Because of their core strengths, transparency and liquidity. While private credit is getting scrutinized for hidden risks, the public markets offer clarity. You know the price, you know the risks, relatively speaking. So for investors who are worried about credit risk but still need some income, public investment-grade corporate bonds are looking like a really solid alternative to private credit right now. You know what you're getting, and you can sell it tomorrow if you need to.
Okay, that makes sense. Public markets offer that visibility. Now, what about insight number 3? You mentioned how people get advice.
Right. That generational split we talked about. Older investors wanting custom advice, younger ones wanting tech and transparency. It's driving a shift in how financial advice is delivered. We're seeing this huge growth in what's called the hybrid model.
The hybrid.
Yeah, it's trying to offer the best of both worlds. You don't have to pick between, say, expensive old-school advice or just using a basic robo-advisor on your own. The hybrid approach combines human advisors for the complex stuff, the personalized planning, with cheaper, transparent digital tools for everyday management and tracking. It kind of meets that modern demand for both support and visibility.
That focus on transparency, it seems to be the running theme here.
It really is.
That what?
And that brings us to our final thought for you, something to chew on. That Gen Z demand for transparency. It's not just about fees or having a slick app. Sources suggest it goes deeper. They want transparency on ESG factors, environmental, social, governance. They might even want to know how their shares are being voted.
So it's about values alignment too.
Exactly. In the long run, this push from younger investors for total transparency could really change market standards overall. If you, as the investor, start demanding to know not just the cost, but also the impact of your money, what kind of world it's building, how the companies you own are governed, you're ultimately pushing the whole system to be more accountable, more healthy.
So wrapping it all up, the main lesson seems to be, don't be fooled by a calm surface. Investor confidence might look high, but be really aware of the pressures underneath. Things like China's influence shifting global prices or that anxiety building up in private credit.
Yeah, stick to the basics. Demand transparency, value liquidity, and do your diligence.
And maybe ask yourself, what standards do you want your financial institutions to uphold? It's a question worth considering. Don't forget to subscribe and hit that like button.